there's not a direct correlation with rates, but broadly, we have seen an impact from the pandemic in moderating in growth, which does tie to GDP. But we've seen our business is resilient during downturns. People continue to save. They continue to insure what's valuable to them. So policy count at one level has continued to grow, and people have been saving more. We saw significant net positive flows into individual pensions and into workplace pensions in 2020. And we expect that theme to continue through 2021. Actually, the biggest risk is people aren't invested and they're sitting in very low returning cash assets.
And yet, Jason, I was looking at, I don't know if you saw it, nice to see you, by the way, the December big Deloitte survey. I think it was mostly a US survey, but it was looking at the whole industry. I don't know if you took part in it, actually. It said growth and profitability in both annuities and many non-term life insurance products will likely be impacted not only through 2021, but it says and beyond by persistently low interest rates. Although you must be relieved not to see negative rates as well, I can't see where the growth in profits is necessarily going to come from.
The significant uninvested savings here in the UK, but if I stay in the UK for a moment, there's a lot of people in cash who are looking to go into long-term or lifetime savings products. There's still good earnings, and people are primarily saving as a percentage of their monthly salary. So these are long-term secular growth drivers that will continue to grow the assets under management for us as an industry. And, there might be some slightly lower GDP in the longer term, but I don't think that will take anything away from the really strong underlying growth drivers.
I'll challenge you on where the driver and your margin is going to be a little bit, Jason, if I may. I mean it in the best spirits as well, because I look at the same survey I was looking at. It said where the margin improvement is going to come from. And they're talking about 65% of companies see a cost cutting of between 11 to 20% in Europe. 19% see over 20% as well. So I think we're still in a cost cutting phase, aren't we, Jason?
Absolutely. Efficiency is certainly at the heart of success. For us to offer, I'll stick with pensions, which is an important part of what we do. For us to offer and be competitive, obviously, and to grow the profits, we have to continue to be more efficient. It's a scale game. It is a competitive industry, so we'll continue to seek more efficiencies directly through cost reduction, but also through growing the amount of assets that we've got, which does produce further efficiencies as well.